Good morning, ladies and gentlemen. It's my pleasure to introduce this first panel of this conference. And we have three distinguished speakers in this panel. But beforehand, I would suggest you to answer a poll, which will be displayed in the screen. If you agree, you can answer the two questions which are proposed to you. It will help us to fuel the discussion during this panel. Okay, during this poll, I can present the speakers. First, we have Claudia Kruse from APG, one of the major pension fund in Netherlands. Then we go north with Jan Rasmussen from PensionDanmark. And we have also Jean-Jacques Barberis from Amundi in Paris. So thank you, the three of you, for being here today and participating to this panel. I would suggest to organize it in 4 rounds. And during this first round, I will give the opportunity to each speaker to briefly introduce himself and also to present in 1 or 2 sentences the main focuses of his or her ESG policy in her organization. And ladies first, of course. So Claudia, the floor is yours.
Thank you very much and delighted to be here. So my name is Claudia Kruse. I work for APG Asset Management. We are a fiduciary manager for Dutch pension fund. So we manage a bit of over 500 billion euros on behalf of Dutch pension funds, the largest of which is ABP. And about 75% of our assets are managed in-house, and we are an active investor. In terms of what the focus areas are, they are determined by the responsible investment policies of our clients. And ABP has defined its approach within 3 transitions. That is the energy and climate transition, the digital transition, and the transition theme of natural resources. And our focus areas are very much about being clear about or being selective about what we want to be in the portfolio. So our investments have to be assessed within the quadrant, within the diamond of risk, return, cost, and ESG. And I'll stop here for now. Thank you.
Thank you, Claudia. Then I move to Jan. Could you give a brief summary of who you are and what is the main focuses of your ESG policy? Your microphone, Jan, should be unmuted.
Thank you. Thank you very much. Thank you for being here. Well, I am head of ESG in PensionDanmark. It's a relatively new and young labor market pension fund established by the social partners some 30 years ago. There is an AUM at the moment at 50 billion euros, but we are growing quite fast since the net cash flow is positive, since many of our members are pretty young still. PensionDanmark is a defined contribution scheme, and that gives a bigger freedom when we invest, and it makes space for investments in the alternative space also. If I've just brought 1 slide with me to explain our approach to ESG, and we could see it here. Maybe there are 3 versions of our ESG. It's been a journey. We started with, is the slide on, by the way? It's on, good. We had a version 1, we could say, where we blacklisted companies we didn't like. That was the easiest way for us. And then we found out that this was not working that well if we wanted to achieve our goals, and we became instead active owners, like I think most of the investors are today, and having dialogues and voting with companies. But in the last 4 or 5 years, impact investing has maybe overtaken the main role, or is at least as important as our active ownership. And I think this will be enhanced by the set of SDG indicators that are now provided to the market, and the EU regulation that also is focusing on indicators and metrics. Our focus in impact investing has been renewable energy, sustainable buildings, and we have also had some collaboration with the blended finance, development finance institution, blended finance vehicles towards poor people and women in LDCs. I think I'll stop here for the beginning. Thank you.
Thank you, Jan. Now I turn to Jean-Jacques Barberis, please.
Hello, thanks, Joël. Thanks to everyone. It's a pleasure being with Claudia and Jan. For Amundi, to describe Amundi, I would say there are three things three figures that highlights a little bit where we are in terms of ESG. So we reported 705 billion euros under SFDR Article 8 and 9 in terms of AUM. In the last 3 years, we deployed a little more than 27 billion into dedicated climate change solutions. And in the same last 3 years, we deployed as well 3 billion on dedicated solutions on social aspects. And when it comes to, I would say, our main areas of focus at the moment, when it comes to our ESG policy, so I think the ESG integration into all our investment platforms is behind. So at the moment, we're focusing basically on three things. First, it's the discussion with our clients on the progressive alignments of their portfolios vis-a-vis net zero targets. So that's one big area of focus for us at the moment. The second is a focus more and more in everything we do with a linkage between the E and the S. So really focusing on methodologies to onboard the just transition question. And the third, we have two very strong, I would say, areas of engagement vis-a-vis companies we invest in. First, requesting that they enter into the SBTi process. And second, this year, we're particularly vocal on the fact that we're expecting compensation KPIs for CEOs and top managements linked to ESG, but not only, in particular for main emitting sectors directly linked to reduction of emissions in absolute terms.
Thank you very much, Jean-Jacques. And now I turn to my second round, and I will start with Claudia once again about SDGs. Because in APG, I understand that you put a special emphasis on SDGs. So could you give us some more details on which SDG you favor, and how do you map your portfolio to SDGs, which are originally more designed for public policies rather than for institutional investments? So if you can elaborate a little bit on this issue, thank you.
Yeah, thank you. So as I said, we are investing on behalf of Dutch pension fund clients and ABP in 2015. So just when the SDGs were published, issued a commitment that it would double its then called high sustainability investments, which were loosely linked to the Millennium Development Goals, that it wanted to double the investments into the SDGs from 2015 to over 2020. So for us, it was the challenge of finding 58 billion of investments that contribute to the SDGs. And as you said, indeed, the SDGs were written as targeted at policymakers. However, we have translated them into investable opportunities. So developed a taxonomy around this, which is available. And that is very much focused on the core business of companies, to what extent their products and services contribute to addressing the SDGs, to what extent they offer a solution. And Now that's good and fine if you have a taxonomy, but then you also need to develop the underlying data. And we have done so with the help of AI, a dedicated technology platform, and now are able to assess a global broad-based capital markets portfolio with this data, and have also made it available in partnership with 3 other global asset owners. So that is British Columbia, PGGM, and Australian Super. So what this allows us to do is to really go into our portfolio and for all of the SDGs, look at which of our investments contribute to the SDGs and by how much. And that for us is also something that we report publicly for a number of years already. And it means that we do not have a focus on a particular SDG. However, of course, there are, the SDG, around climate and energy. Naturally, we have more investments there, and we actually have defined, ABP has defined a target linked to investing in affordable and clean energy. So for us, the SDGs are very much something that is part of the portfolio. ABP is aiming to have 20% of its assets under management invested in the SDGs by 2025. And it is not that we have a dedicated fund or a dedicated allocation towards this. This is really across all asset classes and in the entire portfolio, and it forms part and parcel of each and every investment strategy.
Thank you, Claudia. I think that it's really the best practices today. So thank you for sharing your experience. Jan, you develop an economic approach to SDG. How do you incorporate them into the risk-return analysis of your assets?
Well, we perceive the SDGs as an investment catalog that exhibits the demand in the medium term from the world community. So our approach is that it's primarily a big number of investment opportunities rather than a risk. And when we look at the listed equity, our in-house fund managers, they take indicators for overall SDG alignment into account when making investment decisions, and they also have where it's available access to identify concrete SDG indicators for the relevant company. Also, transition performance indicators are studied when making investments. Companies, like Claudia said before, that offer solutions, and it could be whether clean water, good health, sustainable cities, generally presents upside investment opportunities. And this is also very good when we in the ESG team shall collaborate with the investment teams, because this is really the art of stock picking, and that is something that the investment colleagues like to do. So this looking at SDG impact as an investment opportunity makes our collaboration much easier. Of course, in the short run, we acknowledge that market fluctuations and changing interest rate environments or the business cycle could give some tactical reasons to have another allocation than the one that has the most desired impact in the short run. And we acknowledge that because we also have to give our members good pensions. So one could say that at least in the listed space, we have a medium-term strategy, but with short-run flexibility. Then if we move to the alternative and more illiquid space, where we have investment horizons of, say, 5 to 20 years or even longer, the story is different. The focus here is primarily on the medium-term investment strategy. It takes us 4 years to develop and build an offshore wind farm, and we need a power purchase agreement for the supply of the electricity to the local grid to be confirmed, and we need a risk-sharing structure with our operational partners to perform a prudent risk return analysis. Since 2012, all our new buildings have achieved gold certificate for sustainability according to the German DGNB standard. And this is not because we are all hippies in PensionDanmark, but mostly because we perceive it as a good business case. The higher cost in the construction phase when you're building sustainable is quickly covered by bigger interest and demand from the tenants that appreciate a healthy indoor climate and low energy bills. And moreover, the buildings themselves will have a longer economic time horizon, a longer economic life when they are built with sustainable materials. So this means higher rents for a longer time and makes the risk return profile of impact investing attractive as well. So I think our experience is, to say it shortly, that it is possible to do good and do well at the same time.
Thank you. And Jean-Jacques, what is the demand you receive from your main clients on SDGs? Do you offer specific products, or do you incorporate SDGs into your mainstream products?
No, thanks for the question. And I think SDGs is one of the challenges that make me modest as an asset manager, because I think we're probably far less advanced than Claudia or Jan on that front. Coming back to your question regarding the demand, I think what is interesting is to focus a little bit on the demand that we can see from the retail investors, because we are also, it's SDGs, I think, are no longer a question for institutional investors only, but for retail as well. And last year, we did a little survey asking basically to the clients into our retail networks, what were their expectations in terms of impact reporting, what were the main elements they wanted to have impact reporting on regarding, I would say, the SDG field, or the things that for us were important to measure in their portfolio. And the results were slightly surprising, because I would have bet that climate would have been the first, which was not the case. The first one was water. The second was regarding plastic pollution, and the third was about climate. So it's in our retail networks, at least that was the demand. And what do we do of that? Well, what we try to do is, first, I think we don't pretend to be good or sophisticated on all SDGs. We try to focus on ones where we think we're good at, so particularly on climate and on the SDG related to fighting inequalities, which are our two main areas of focus. For these two ones, what we do is we have historically developed, I would say, dedicated products or methodologies, but that afterwards are feeding the overall ESG approach that is deployed into all our investment processes. So, for instance, I can give an example. We recently launched a fund that was dedicated to the question of how global companies can participate to the reduction of social inequalities in the territories they operate on. We developed a methodology trying to capture that in a global equity space, and progressively this is feeding our S approach overall the firm. So that's one way we do it. And second, on I would say dedicated SDGs, we are developing dedicated products with one area of focus to make them readable the maximum possible, that we in particular deploy among our retail networks. So for instance, we have launched 2 years ago a strategy that is dedicated to education. We are going to launch some regarding biodiversity. So really two approaches, a focus on two SDGs in particular that is feeding the overall ESG process of the house, and dedicated, I would say, approaches for some selected SDGs that we deploy in particular in our retail networks.
Thank you, Jean-Jacques. As you saw on the screen, we launched a poll, and the results were quite diverse in terms of percentage on SDGs. So some of the audience is really interested in, some others are not. So it's an ongoing subject. There is a second poll on my third round about investment dilemmas. The question was, is it better to invest in a company in order to engage it to reach ESG targets, or to wait until it has? And once again, the answers are interesting, because you are 70% to answer yes, and 25% to answer no. And then I turn to Jan. Investment decisions are not always straightforward. What is your position with a company with mild ESG ratings of involvement? Do you ban it, or do you prefer to stay invested and push it to improve its ESG profile?
Well, I certainly think this is a dilemma, but it's not only an ESG dilemma, it's also an economic dilemma, I think, because overall a bad ESG assessment of a company is usually associated by a bigger economic risk when investing in them. So I think that's important, and that is the reason why our fund managers will usually underweight companies with low ESG ratings. So it's not something that we will take a discussion about in our ESG committee. They will have the metrics, the ratings, and the relevant data for the companies available when they invest. And all other things being equal, they will underweight companies with low or bad ESG assessments. But it's not that easy, even, because it's even more complicated, because the prospects of improving ESGs in companies is also a prospect of upside return. So you could say that if you're investing in the top leaders in the world, maybe the upside potential for engaging with the companies is not as big that if you're, let's say, try moving somebody with medium or even low medium ESG ratings in a more responsible direction. If I should be a little more concrete, you could take an example of a huge global mining company that has many production facilities and many different types of mines, that announces that it will phase out coal mines within a few years. We are not investing in thermal coal production, but if there is a company that says we will not produce thermal coals within, let's say, 1 or 2 years, we will sell or demolish our coal mines, should we go and be shareholders in that company and try to help it and encourage it to perform its strategy, or should we wait and announce to the company that when you have phased your coal totally out, we will come and be ready to invest in you? That's a dilemma. Another dilemma could, well, this is the kind of dilemmas that we are facing. And usually, I think we will take the approach that it is interesting for us to be active owners and encourage the companies to move in the right direction. And this decision is, as I said in the beginning, primarily a pure investment decision from the fund manager. We do not tend to make too many so-called political exclusions in the ESG committee. So I think that's the main trade-off. Of course, there can be reputational risks as well with bad ESG behavior, and then we need to have a discussion with it. So I think that's the dilemma.
Thank you very much, Jan. And Claudia, in APG, what is your approach of this kind of dilemmas?
Yeah, so we do apply exclusions which are product based. controversial weapons, tobacco, etc. So there, we draw a hard line about what we do and don't want to be in the portfolio. And beyond that, we apply the so-called inclusion approach, which is really, from an investment perspective, selecting those investments that in an assessment of risk, return, cost, and ESG, we want to be in the portfolio. So you have to fully understand the features of a company and then decide, should it be in the portfolio? And for that, we have actually conducted a proprietary assessment whereby all our capital markets portfolio, that's also including the credit side, so not just the equity side, have all been categorized into ESG leaders or laggards. And that's a sort of combination of a normative and a relative assessment. And it's also sector specific, but it really means that for a company which is deemed an ESG leader and it is a good investment, you can invest. If it is an ESG laggard, and on the other dimension, it is a good investment, you can only invest on the condition that you engage for improvement. And I think that's really, so engagement, active ownership is a condition of being able to invest into those companies, because we do believe that ESG, that companies should improve on ESG. And I think that really is at the core of what we believe in, that we have a responsibility as well as an opportunity as an active owner to drive for ESG change at those companies. And in fact, that it is a minimum threshold that we have to apply. So, but also those engagements, it's not, we do need to see progress by companies. So where over a certain amount of time, we don't see that a company improves, then we will look very carefully at whether we want the company to be in our portfolio or not. And of course, engagement for us, it's not limited to sustainability issues. It is very much also tied in with our approach to corporate governance at companies, with exercising our voting rights, where we also address those topics. So it's a very holistic view that we take. And for our real estate investments, we are very clear that it is those that are sustainable that are the investments that will perform in the future. And we very strongly believe in sustainability performance, and have been a founder of the global real estate sustainability benchmark, GRESB, which first kicked off in 2009. And our investments that we make have to agree to participate there, and also to reach a certain performance level. So it is very much integral to it. First and foremost, we would like to steer on improvements for those companies that we choose to invest in.
Thank you very much, Claudia. Then I turn to Jean-Jacques, perhaps on behalf of time, because we have only 5 minutes left. I will directly go to round 4 about thematic impact investment. And Jean-Jacques, could you tell us some ideas on thematic investment? Do you think that thematic investments is the best way to address the retail market and to embark retail networks and small investors to ESG journey? Because we see that institutional investors are now on board definitively, but we have also to put on board all the retail markets. And since Amundi is a very big player on this market, you certainly have some interesting ideas on this.
Yeah, thanks, Joël. Just one word on the previous question. I think I concur a lot with what has been said, and I think we share the same kind of approaches. When it comes to exclusion, I think on our side, for me, exclusion is justified only by science. It means that it's basically because some activities shall no longer exist based on the scientific scenarios we have available, that we can decide to totally exclude from investing into some activities, coal being one very interesting example. And based on the report of the International Agency of Energy yesterday, I think this is a number of discussions regarding the new exclusion policies that maybe need to be put into place. Coming back to your last one, I think not the dilemma, but the thing we face as an asset manager that is serving a number of retail clients is that basically nobody knows what is ESG if you're the woman or the man in the street. This is something complicated, awfully impossible to understand if you're an end client most of the time. And therefore, the whole question for me is, how do you simplify, not being simplistic, but how do you simplify the debate vis-a-vis these clients, and at the same time not falling off the cliff, which would be to simplifying too much and therefore to fall into impact washing, greenwashing, or SDG washing. So that's
sorry, Jean-Jacques. I see the results of the full question. What is the main hindrance to attract retail market on ESG? And the highest percentage is ESG awareness. Exactly what you say.
But which is honestly super complicated, because even if you test the labels, for instance, are the labels known, well known, etc., it's a jungle, which is very good for biodiversity, but which is not great in terms of challenging investment flows. So I think we're relatively strong believers in two things. First, the fact that all the open-ended funds that we propose I would say, have dedicated ESG KPIs that are reported to the end clients. So that's one. And second, I'm personally a very big believer into thematic ranges because I think they are an easy way to access to some of the concerns or ambitions we have regarding sustainable finance. But at the same time, the difficulty, of course, there is to be extremely precise and serious about the impact reporting that you are proposing, which is not easy, which is not a piece of cake. And therefore, that's why I think it's a very good tool. And at the same time, we need to be extremely serious about the type of things we put on the table. And I think that the regulation is going exactly in the right direction, helping more and more the end investors to find a way in the ESG jungle.
Thank you, the three of you. It was very interesting, at least for me, this exchange. Thank you very much, Claudia. Jan, from your experiences are very inspiring. And also thank you very much, Jean-Jacques, for this broad approach of ESG, not only to institutional, but also to retail clients. And then I leave the floor to the second panel. Thank you, the three. Bye.
Thank you very much.
Thank you very much. Bye, Claudia. Bye, Jan. Bye-bye.